how this client paid off their mortgage in 14.6 years instead of 21 years. And my friends, it's not about rental cash damming. Hello everyone, my name is Sylvia Ho and I'm a financial landlord consultant. I'm also a mortgage agent for the last 24 years and a landlord myself. I teach landlords how to save money by decreasing the taxes that they pay the government and saving interest that they pay the banks. Today, I'm going to talk to you about a strategy, about a conversation I had with a client. If you like my training videos every single Wednesday, please like, please comment, please subscribe to my YouTube channel. So I was talking to a client yesterday and their mortgage is up for renewal. This is an old client of mine and they're like, hey Sylvia, we got awesome rates with you last time. Our mortgage is coming up for renewal in June. We'd like to know what are our next steps. How do we get even better rates? And I asked them a very simple question. And I was like, why do you want a good rate? And they're like, what? What do you mean? Well, we want a good rate because we want to save money. But as we dug deeper, the real reason they wanted to get a good rate is because they wanted to pay low interest, but it's because they wanted to retire in 15 years with no mortgage. And in their mind, they're like, the lower the interest rate, the less interest I pay to the banks, and therefore I'll pay off my mortgage faster. But my friends, it's not about interest rate. It's about mortgage strategy. So today I'm going to talk about the 3 different options that I gave this client, and I'm going to talk about the strategies behind each option. So option number 1 for this particular client is they can renew with their current lender. Their current lender was a really, really good lender that I set them out with, and they were getting a really good rate. And they could continue on with their lives. They could pay their regular bi-weekly payments. And if they have any extra money, they could do lump sum payments and hopefully pay off their mortgage before retirement. That's option number 1. Option number 2 is they could buy a rental property by using the equity that's currently in their home, so they don't have to use any of their own savings. So their house was worth about 1.3. They owed about $500,000, right? So they had a lot of equity. So in my program, I teach clients how to use the equity from your home to buy a rental property, and how you put by borrowing for the down payment to buy a rental property, you put yourself better in a better tax bracket, and you create tax efficiencies for yourself. And then you apply the strategy of rental cash damming, is where you take your rental income that you're going to get from this new rental property, because they're not a landlord right now, right? Let's just say $3,000 per month. You take that $3,000, you prepay your owner-occupied home mortgage, and you prepay their owner-occupied home mortgage, and then you would use the line of credit to pay for all the rental expenses. Now, this is a very specific mortgage product that you must get, and it's called a re-advanceable line of credit. And by doing this, by applying the strategy called rental cash damming, they'll create extra tax savings for themselves. And for them, they were making $300,000 a year, so they were at the 50% tax bracket, the most expensive tax bracket. So they're gonna, by applying this rental cash damming, they're gonna get back some of that hard-earned money that they've given to the government every single year. And with this strategy, because you're gonna get tax savings, means that it can translate into tax refunds, and with those tax refunds you can prepay your mortgage again. So that means with rental cash damming, you're prepaying your mortgage 13 times per year, $3,000 every single month from the rental income. So you're using that rental income more powerfully, if that's even a word, right? And then you're going to get tax savings, and then you're going to prepay it with your tax refunds 13 times a year, and that would shave off 8 to 12 years off their mortgage automatically. They're on 21 years, so they would pay off their mortgage really, really, really quickly, like under 10 years. But for this particular family, they were not ready to be a landlord yet, even though they had the income of $300,000 to qualify for it. Option number 3, and this is where we're going to focus our efforts on today, and this is the training, is on the power of the paycheck. It's a very specific mortgage product. It's a super powerful mortgage product that, when used properly, and it's only for, it works really, really well for the correct family, for the right family. where there is a delta between the money coming into your bank account versus the expenses going out. So let me explain to you how this product works. So the strategy is called Power of the Paycheck. So this particular family, they were getting $10,000 net into their bank account. So that's after paying all the taxes and then their unions and this and that. They got $10,000 into their bank account. And then they paid all their expenses. And all their expenses, including the mortgage payment, was $8,000. So every single month, they were saving on average $2,000 per month. So let's just say $1,500 to $2,000 per month on average they were saving. And by applying this one strategy alone, the Power of the Paycheck, they went from 21 years down to 14.6 years. And oh my goodness, the wife's eyes lit up. She's like, what? I can pay off my mortgage in under 15 years and it doesn't cost me a penny out of my pocket? How does that work? So this is how it works. Think of this product as a super crazy large line of credit or a checking account with a massive overdraft. Let's just say you owe on this line of credit $500,000. And in this case, it's the mortgage, right? You owe $500,000. You get your income come in for 10 grand. So you work your day job, your T4 job, and then you get paid $10,000. It goes into this line of credit. So now on this massive line of credit, you only owe $490,000. So what that means is you're going to pay interest on $490,000 for 28 days of the month until you have to pay your bills. And then your mortgage payments come out, your credit card bills, your food, your groceries, any kids' activities. And then your mortgage jumps, your line of credit, the super large line of credit, jumps back up to $498,000. And then your paycheck comes again. $498,000, boom, 10 grand goes into your bank account, into your massive line of credit. Now you only owe $488. And you pay interest on the 28 days until your bills come due. So you're only going to pay interest on the $488,000. And then you rinse and repeat. And that's how simple this strategy is. Now, this particular product only works for one lender here in all of Canada, and it's called the Manulife One. You may have heard of Manulife doing, life insurance policies, but they actually have a mortgage product. So if you would like to figure out what your potential on the Manulife One product is, comment me below. And I'm going to send you a 5-minute training as well as a link to calculate your Manulife strategy. And so comment me below. I'll send you a 5-minute training video as well as a link on how powerful the strategy can be for you. So for this particular client, I can't wait to onboard them onto the Manulife One mortgage product. It's going to be super crazy powerful. And now they're like, hey, if I saved an extra $100 per month and I only, I saved $2,100, would I pay down my mortgage even faster than 14.6 years? Yeah, absolutely. So that, my friends, is the training for this week. It is the Power of the Paycheck. It's a Manulife One product for this particular client. If you have a mortgage that's coming up, or even if you're mid-term, you're halfway through your mortgage, you can look at these advanced financial strategies. And then it's a numbers game. We figure out whether it makes sense for you to do it now or whether it makes sense for you to wait until your mortgage comes up for renewal. And if it makes sense for you to stay at your current lender and wait till your renewal, then that's what I'll tell you. But if I run the numbers and I'm like, hey, if we broke your mortgage, paid the penalty, and we started the strategy today, and you would shave off 7 years off your mortgage, would you do it? Yeah, absolutely. Thank you so much for listening, my friends. My name is Sylvia Ho, and I'm a financial landlord consultant. I'm also a mortgage agent for the last 24 years, and a landlord, and a mom, and I'm also an avid Leafs fan, so go Leafs, go. Thank you so much for listening, and tune in next week for more powerful, advanced financial mortgage strategies. Take care, my friends. Bye.